So, good morning, good afternoon, good day, everyone. Happy New Year. Um, this is Steve Nicholson, Global Sector Strategist for Grains Oilseeds for Rabobank, and it's great to be back at the Potato Business Summit again this year and to see everybody. Uh, there's a lot to talk about, and I'm going to dive right in. I've got more material I can get through, but I'm just going to dive in and start it. And I want to show you this first slide, and I could spend my whole time just talking about each of these issues on this slide, but it's I want to talk a little bit about the Rubik's Cube that you see here and what it means to me. So when you look at the Rubik's Cube, this is from Barron's back in an issue in November. And I thought it was very apt to top with it. The world on edge and markets on edge. Is it the world is moving all the time? A Rubik's Cube has a sharp edge. So if you get too far, you drop off. And if you move it, something changes. And I think that's where we are today, is that the world has changed and we're on a razor's thin edge of anything that could happen does seem to happen and cause a lot of consternation. But a couple of things I want to pull out of this particular slide and just highlight because it fits here a little bit better. We've had 20 to 30 years of really, since the wall fell, and now you're talking 30 years of really relative peace and prosperity in the world. And that's, I hate to say it, not the norm. And where we're seeing everything change now back to more norm. And we think about the conflicts in Russia and Ukraine, the conflicts in Israel and Gaza between Israel and Hamas. You have other players in the Middle East now getting involved. Iran, the Houthis in Yemen, and Lebanese, the Hezbollah. So you see lots of challenges in that part of the world, and I don't think that's going away. And of course, China is continuing to be a challenge for a lot of countries. And how does this all come out, and how does this work? Just as a piece of this, it's an election year in the States, and on top of that, I think I get these right. There's 77 elections in the world in 2024, which includes 50% of the world's population. So again, another big year that's going to happen. And I'm going to use this word, which I hate, but it's sustainability, and that's the last time you'll hear it. But I want to talk about it in the sense of what it means. I think we have to be aware of a couple, three things in this. One is, of course, water supply and water quality come under that heading, and that's going to be crucial to many of you and many of us around the world. Also, one of the things that we're looking at as a research group is to look at soil health and soil resilience. We think that this is a bit of a agriculture is going to continue to evolve like it has for forever. And these are two of the areas where a lot of that evolvement is going to happen and where the improvement's going to happen. The other thing is, and I said this last year, and I just remind producers, in this whole area, it's important that you get your data in line and get it in place now so that when someone comes to you and says, "What are you doing?" you can hand them data and tell them, "This is exactly what I'm doing." So you want to be in a position to tell them what you're doing rather than them to tell you what to do. So I will stop. I will leave that there, but I just want to kind of leave that message. But you can see all of the things happening and how the cube continues to move and the globe continues to move. And I think that's the challenge we have. So let's dive into sort of the economics or the macroeconomics of what's happening. And as the title is, it's a mixed bag, and it's a mixed bag here in the United States as well. And it's a very strange phenomenon when you look at the economic situation, particularly here in the U.S. We're actually in a pretty good place, but the consumer has this very gloomy view of the world, and I'll get into that a little bit later. But I kind of wanted goes right to the heart of the GDP. When you look at GDP, the world is still positive growth. We saw a little bit of dip this year in some countries, but overall, you saw a continuing very good situation across the globe is going to see positive growth globally. And I think for those of us in agriculture who are exporters, that is a good move. So if we come back to home and look at it, the third quarter, we haven't got fourth quarter numbers yet, but we were 4.9% growth in the gross domestic product in the United States. That's phenomenal. Particularly when that is kind of the high water note, and you can see what's happened there during COVID in 2020. But after that, other than a little dip early on in 2021, we've been on a trajectory of good GDP growth on a year over year basis by quarter, and I think that's a good thing. And we don't we and we could talk a lot about the soft landing of the Fed, and I don't want to oversell it or get over exuberant to partially quote Chairman Greenspan, but the economy is still humming along pretty well. And I think that will be the case here in 24, despite a lot of a gloom and doom that there will be a recession sometime here in 24 second half. But I will say this has been the most forecast recession that's never happened. So keep that in mind. But if we look at what the Fed's done, and let's talk about interest rates because that's on everybody's mind. You could look that we're up that 5.25, 5.5 federal funds rate. A lot of expectations that we'll see upwards of 6 cuts in 24. I think that's a little overblown. I think the Fed still is very concerned about the inflation and wants to make sure that it is dead. They want to make sure that it is, I guess maybe not dead, but make sure that it is corralled so that we don't have the run up we had last year. But the fact is, I think we will see a couple small setbacks in interest rates in 24, but I don't think quite as much as what the market is factoring in right now. Here's the infamous dot plot, and as you can see, when you look at what the FOMC participants, when they polled them, they're indicating 50, 75 basis point cut in 24. So that would be 25 basis point cuts in 24, and I think that seems reasonable. That may not be exactly what the market's thinking, that there could be more, but I think it does seem reasonable. It could be 2 or 3 25 basis point cuts. Here is an interesting chart I just want to show to you, and it's not. It kind of addresses the facts versus where kind of people's level of gloom is. So this is the 10-year treasuries, and if you look at where they were a year ago, which is why I drew the red line, versus where they are today, we're almost on par with where we started the year a year ago. When we talked a year ago, we were about 3.8%, and now we're just under 4%. And so we're just about where we ended up the year, although a lot of volatility in between, as you can see there, but we're just about where we started a year ago. And so things are not as bad as we anticipate our perception is, I guess the way to put it. Now, the interesting thing here is we still have negative yield curves, whether you look at a 10 minus a 2-year or a 10-year versus a 3-month treasury. We're still deep, in a negative yield curve, which has always been an indicator, pretty good indicator of a recession yet to come. Now, I will say one thing. I looked at this several years ago. That recession is about an average 19 months after the curve goes negative. But it could be upwards of 2 years before you see a recession. So keep in mind that this is it may be a foreshadowing, but it is not very good on the timing. It foreshadows a recession, but it does not give you very good indication of timing. So just keep that in mind as well. But if we turn to inflation, and you can see we've seen quite a reduction from where we were a year ago. So core inflation right now is running just under 4%. That's as of November. That's versus just under 6% a year ago, November. So we've seen, again, like we saw the interest rates, we've seen a lot of volatility in the last year, but we've seen also a pullback in that inflation from what we see. Now, I will concede to you, and I think we have to remember this. This is also a mathematical thing because you're coming from very high level, and so you see that. But at the same time, we definitely have seen a reduction in costs, and you start to dig into the numbers, you see reductions in travel costs, you see some reductions, particularly in cars, mostly used cars. Now you're not going to get them; they're not going to be cheap, but they're certainly down from where they are. You've seen gas prices come down. I think as a consumer, I wouldn't say that I've seen food prices come down, but I see a lot going to my grocery store. I see a lot more things on sale than I saw a year ago at this time. So some good news there, and obviously a little caution as well. Now the conference board does look at several different things, and I think these are worth saying. Their leading economic indicators are also flashing a recession, and that's what you see there in that blue line on both of them. They tend to be a little bit lagging in forecasting a recession, but at least are showing that they are continuing to show an uncertain future going ahead. The more interesting thing, though, is to look at consumer confidence and think about where the consumer is and what's the consumer thinking. So on the left-hand side, you see the consumer confidence that, it's certainly had its challenge in 2020, but it's come back and is showing the consumer at a pretty good perspective. And the latest one that they did in November showed the consumer confidence up. If you go to the right side, or the right side of the chart, the black line is the chart you just saw on the left side, is present. So how do you feel about the economy today? And the consumer feels good. But when you ask the question, what do you feel like 6 months from now? You can see how pessimistic the consumer is. The consumer is just not very happy. They just are very worried about the future, and that gets manifested lots of different ways. And so that's where this dichotomy that you have, and we'll talk about that here in a minute, as to where the consumer thinks they are today versus where they think they are going to be in the future. And there's really, really quite a difference there. But there are some concerns about the consumer, and I think the consumer has I sense some confidence or worries. If you look on the left-hand side, this is from the St. Louis Federal Reserve. A lot of these, Fred, if you've never been there, it's a great site for us economic nerds. But you can see consumer debt is at a very, very high level. And so that's, credit cards, things like that. You go there. And then if you look at the right-hand side, and I've sourced it there at the bottom in the orange is the website. This was an article done by the St. Louis Fed looking at the stress of U.S. adults in their financial situation. And you can see when we look at credit card debt and we look at auto loans, you can see that we're at levels that we haven't seen since the Great Recession back in 2008. So I should have said this up front. So they looked at this in the third quarter of each of these years, just so you get an idea. So they looked over a quarter and also compared. And you can see the level of stress among the consumer, financial stress, as they look at it, is fairly high and certainly rivals the Great Recession. So that gives you a flashing red light or a flashing yellow light that there's some caution. You can see mortgages are not an issue here. Obviously, that is a certain reflection of the low interest rates and the fact that the consumer did a lot of refinancing during this time where we had low interest rates, and has a house that has a very reasonable cost on it. And it's somewhat locked up the housing market because the consumer is not wanting to sell and buy something new because they have a very good mortgage rate. So that's the green light if you have for the consumer. But here's when we start to get the light a little more greener for the consumer. You look at the consumer, and the blue line here is the CPI, so the inflation that we just talked about a minute ago. You can see the up, and now it's come down, and so it's running, as we said, about in that 4% area. But the red line is average hourly earnings. And you can see now for the first time in a number of years that percent change in total hourly earnings or average hourly earnings is over the rise of inflation. So wages are keeping up with inflation now, and the consumer or the worker is able to pay or keep up with that inflation move because their wages have gone up precipitously to kind of try to fight that situation. So that's a green light if you have for the consumer. And then if you look at total disposable income, it's been up and down. Obviously, all both in the Trump years and the Biden years, we've seen COVID payments has helped the consumer a lot, and you can see it come down. But you can see now disposable income is starting to pick up, a reflection of better wages and inflation coming down, and so the consumer has a little bit more money in their pocket to spend. And we see that. Obviously, you had really good sales here in the Christmas holiday, and the consumer continues. And you can see, right or wrong with the debt situation, they have been spending heartily by looking at their credit card debt and also trying to buy a new car. So the consumer's a good spot. And then on top of that, and I think this is the piece where it's going to be very difficult to have a really difficult recession or a deep recession when you have job production. And here you see job openings, which is the top red line, and the blue line or the bottom line is unemployment. You see that gap is still pretty wide. It is closing, but you're still seeing there are more jobs open than there are people looking for employment. And then if you look at the numbers that we just saw here that were published right before the business of the Potato Summit, you saw the December numbers are over 200,000 more jobs. They did pull back November below 200,000 to 173,000, but you have December numbers above 200,000 a day, a month. So the economy continues remarkably, in my mind, to produce produce jobs for people on a pretty consistent basis. Yes, they've come down after COVID. We would expect that as jobs came back, but to see this remarkable creation of jobs on a month-to-month basis is going to keep the economy strong because people have a paycheck, they have a consistent paycheck, and they have money. They have money in their pocket to spend. So we're going to stop there on the economy and just say, I think there's some cautions, but you also continue to see some good green lights for the consumer and for the economy as we go forward here over the next, at least over the next several months, if not for the next year or so. So with that, let's move a little bit closer to home to agriculture and kind of what we see around the globe and what we see what that means for us back home here. So I'm going to start with the weather, and I think this is where we all worry. It has been a dry year, as we know, and I kind of want to talk about the globe here. So this is the global 1 month index, and I'll show you the U.S. drought monitor in a moment. But overall, I would say you've seen this improve over time. You can still see drought, of course, in the U.S. Corn Belt. You can see it a little bit in the northern plains. You see it partly in South America. Obviously, Europe has improved considerably over the last several months. They've had lots of rain there. It's still raining there and across Russia. And then you can see, of course, in Australia, it's been dry, particularly in Western Australia. And then also you see parts of northeastern China, which is their big agriculture, has also been dry. So overall, it's gotten a little better, but still some dry prospects. But when you start to look at it from a soil perspective, this is where the challenge really becomes. You look at the U.S. Corn Belt, you look across Brazil, you look across Western Australia, even Russia, Europe, Western Europe, and China, still and in Ukraine as well, very dry soils. We have seen some improvement across the United States, and I'll show you that in a minute, but you still see very, very dry subsoil moisture that is a concern for me as I go into 24. As we look, El Nino is still an issue, and we expect that to be the case at least until the second quarter of this year. And you can see in the U.S., it's not going to have a huge impact, but we do see dryness across Western Canada into the northern plains of the United States here this winter. We're seeing some moisture come across the United States, and so we're hoping that does come because we certainly could use the moisture, and particularly if you're a skier. But there's also in this, while it could be a very strong El Nino, there's a high probability, almost a 50-50, that we'll go back to a La Nina fairly quickly, which is fairly unusual. So something to be paying attention to and watching. So here's the drought mark for the U.S. You can see versus a year ago, things look better, but it can, again, still very dry within the U.S. Corn Belt. And you can see the northern plains are a little dry. You can even see some dryness out in the Pacific Northwest. And the southern plains and the Delta are still very, very dry. That's important for sugar beet folks because the sugarcane crop in Louisiana is really a challenge this year. So it does provide a little bit it provides an umbrella for sugar beets to head a little bit deeper south and keep prices fairly good. But if you look at soil, this is where I'm concerned. You look at that topsoil moisture, we've certainly seen an improvement in that. If I showed you this chart 2 months ago, it would look much, much different. But you can see that subsoil moisture is still challenged across right through the middle of the United States and even in Western Canada as you look on the very far right graph. But as you talk to producers and you look around, they say my topsoil looks better, but I dig down, that couple inches, and it's very, very dry there. But let me talk a little bit about weather and some kind of good news and bad news all at the same time. So I took NOAA has this wonderful website where you can actually do a lot of looking at different weather patterns, different weather situations. So I looked at the U.S. Corn Belt, just so you understand this, and looked at it through the growing season, so May through August. And you can see this is precipitation, May through August. You can see the last several years has been down, but you're still within the range of where we've been over the last 130 years. You can see the Dust Bowl years, the 1930s. You can see the drought of 1988 and also even the drought of 2012. We're still not to those levels, but we've been drier, but not without range. You look at this is maximum mean temperature or mean maximum temperature, excuse me, and you can see we've seen increase like precipitation. We've seen an increase to the upside, which you'd expect for what we know. but we're just above the mean, but we're still not, capturing the highs that we saw during the drought, during the Dust Bowl years of the 30s, the drought year of 1988 or even 2012. Excuse me. But we're still within the range. But here was the aha moment for me. Here's minimum temperature, average minimum temperatures during this time period. We have consistently since the mid 1980s, and if you could argue mid 1990s, we've had higher lows. That is a trend we're not within the range of where we've been. We're moving higher. Yes, we have been at these levels before, but you can see the trend is moving higher lows. And that's really troubling when you think about from a plant perspective. The plant's not getting the opportunity to really get a chance to relax over the day. But let's talk about what that means and talk about some of the logistics around the world. The weather has impacted logistics, as has war. And I think this is different from where we've been in the past, in that we have multiple global challenges all at once. And I'm not talking about geopolitical challenges, although that's part of it. But you could see in the US, of course, we've had the challenges with low water levels in the Mississippi River and across many of the major rivers across the US, Colorado River being an example of that as well. Australia has had its logistics challenges now because of great crops, and now they've had a smaller crop and they're a little bit over capacity in logistics, but now they have weather issues, and so they're going to have overcapacity. You look across Europe, you have the Rhine River has been low. The Danube has been low, but the Danube also now takes on increasing importance as a shipping channel because of the challenges in the Black Sea and particularly Ukraine. The Panama Canal has been low. That has hampered, our shipments to the Asia, particularly out of the Gulf of Mexico. I have heard just in the last couple of days, we do see more ships going through the Panama Canal than we have seen for quite a while. It's not a huge increase, but they're allowing more through. Of course, the headline news, of course, has been the Red Sea. And of course, that has been a challenge. We see now companies moving stuff around Cape of Good Hope around Africa rather than to take the risk of coming through the Suez, coming through the Red Sea and being shot at. And so that's raised freight costs, which is depressed producer prices and has increased prices to the buyer. And then if you look at Brazil, they've had logistics issues as well. Not only do they have their classic logistics issues of just not good logistics, but also it's been dry in the Amazon River, which has exacerbated the southern ports, clogging them and challenging there. So you can see multiple challenges around the globe, multiple bottlenecks that have to be resolved. Usually you get one bottleneck or two, but not every place is having them. When we talk about stocks, let's kind of start to move and talk about where we are. So I'm going to move through these fairly quickly. So here's global stocks. You've seen this before. Seen a little bit of an increase here this year. We're still at a very, very high level, but you can see the stocks to use ratio continues to decline. A very clear indication that supply is not keeping up with demand. And that becomes troublesome. And I'll get a little bit deeper and we'll start to peel this onion back. I want you to keep in mind where that stocks level is. 850 million metric tons. So keep that 850 in mind. So let's look at what China is. Now we can have a discussion about whether these numbers are right or not, but I think that the trend is correct. China's holding about 500 million metric tons of stocks in the world. So the majority of the world's grain stocks are tied up in China and will never come out. And so I think we have to be aware of that and keep in mind that means there's less grain on the world market or free able to come. And we'll peel that onion back a couple more steps. So here's a chart that looks at actually 4 charts, and I apologize for the smallness of that. But this is the stocks of the exporters of the world. And you can see from a corn perspective and also from soybeans, we've seen some relief there and that trend has changed. So we're pretty good shape there. But you look at wheat and you look at rice, the trend is still down. And so those are food grains. Those are very important to the world, and those are very important to feed people on a day-to-day basis. And if those stocks get tighter and exporters have less of them, that means there's less available for the world, which gets to the next slide that looks at free stocks. And that kind of goes back to the China slide. Think about, in the case of soybeans is the one exception because you have 3 major players or 3 major producers in the world, and they've all had good crops there. When you look at corn, you look at wheat, and you look at rice, the exporters of the world are holding a smaller share of the total stocks in the world. So if you're a buyer, that you have a smaller basket, of course, to choose from. And so you're going to have to bid up to make sure you get what you need. Now, I talked earlier about when you look in the aggregate, you looked at stocks to use ratio, they're coming down, and you can see that particularly rice and corn are coming down. I'm sorry, rice and wheat are coming down, but you can see that rice or corn and soybeans are coming up a little bit. I would say corn's basically flat, and but we're at comfortable levels when you look at the global situation by commodity. We're not in what I would call a challenging moment at this time. But if you take that and pull out, look just at the exports that we looked at earlier, looked at stocks and look at their stocks to use ratio, you can see that they've been at relatively low levels for a very long time. That's sort of the good news, and we've managed through that. But the bad news about that is if you have any sort of hiccup, usually a production problem or a demand spike, the market reacts much faster than ever before. And we'll talk a little bit about that as I get to wrap up here in a few minutes. But you can see that is, that's where, as you can see, those stocks have been contracting, or stocks to use ratios have been contracting over the years, particularly when you look at corn, and particularly when you look at wheat. That is going to be a real is we make if those crops change, whether it's supply or demand, you get a lot bigger reaction when something happens to the negative side or the positive side. Here's the U.S. stocks to use ratio. No big surprises there. You can see that corn's going up after a big crop and a buildup of stocks. You expect that. Soybeans still relatively low. Wheat sees a little bit of an uptick there, which has given the market a little bit of sigh of relief. But the fact is, they've come down over multiple years there. If we look at demand in the U.S., and I think I want to at least mention this because there's been a lot of discussion about demand. Now, I'm not saying that I have some concerns about some demand, particularly when I look at the corn market, but you can see that demand over time, domestic consumption over time on the left-hand side continues to grow at a fairly consistent rate. You can see exports are increasing as well, but a much more inconsistent rate and are much more volatile. Say a residual supplier of the world right now with Brazil, and I'll talk a little bit about that. Brazil has continued to take more and more share away from the rest of the world, as has Russia when you look at the wheat market. If you look at our projections, and these are some preliminary numbers, you do see that we do expect wheat exports to be relatively flat. We expect soybean exports to come down due to the increase in crushing capacity in the U.S. We do expect corn exports to come back, and that's partly a function of demand from Asia and also a function of the fact that Ukraine will have less and less corn over time to export due to the war and due to production capacity. But over the long term, the U.S. continues to lose share, as you see on the left-hand side of this chart. And you can see, as I mentioned earlier, we continue to see Brazil, we continue to see Russia continue to increase share of both what they produce of the total demand goes to export of their total demand, and also where the U.S., Canada, Argentina has been flat, where the U.S. and Canada continue to decline. And so that's a little bit of a troubling concern as we go forward. But I do want to show you a couple charts. So this is wheat. Wheat production exports are highly concentrated. You can see about 70% of the world's wheat production is concentrated in 7 countries. If you look at the export side, 80% of the world export of wheat is concentrated in 6 countries. If you look at soybeans, and I'm gonna jump ahead. Here's coarse grain, so you can see very similar picture to wheat, but on the export side, it's really basically comes down to 3 countries. The U.S., Argentina, and Brazil control almost nearly 2/3 of the global coarse grain exports. But you look at soybeans or oilseeds, it's much more concentrated, and as you might expect, both production and exports are highly concentrated within the U.S., Brazil, and Argentina. And I think that's one thing that's a good news for us as an exporter, but is a concern going forward. I do need to speak about Ukraine and Russia for a moment, and I will say a couple things here. As you can see, a tremendous setback, 20 to 25 to 30%, both in area planted or area harvested, production, and obviously exports have come down as well. And I'm going to jump ahead a little bit here. So you can see Ukrainian grain exports have really come down since the Black Sea Grain Initiative. We did see very good numbers in November. We'll see if that could continue going forward. I think it's going to be challenging for Ukraine, but this part of the world, they tried very hard to have a better um, to ship along the coast, what we would call the western coast of the Black Sea, which is very close, to try to avoid any conflict from Russia. That has helped some, and you can see those results in November. We'll see if they can duplicate those numbers in the December just closed. I do want to say one thing about Russia. Russia continues to export tons and tons of wheat. And one of the reasons we've seen wheat prices, on the downside is one, obviously corn prices have come down, but obviously because of this. Russia continues to export very cheap wheat, and there continues to be buyers who are willing to buy it and keep that revenue flowing back to Russia. One thing I want to say is that, Russia continues to be, they're going to be good givers of grain to the, people in Africa. Putin is famously said, we'll supply 50,000 metric tons to Africa. Just to keep in mind, let's compare that to what the U.S. has done since 2020. The U.S. has been supplying 1 million metric tons per year of grains to Africa for food. And so Mr. Putin's 50,000 metric tons is really a drop in the bucket. One kind of a couple questions or couple comments on affordability, particularly for fertilizer. So this is, you see fertilizer affordability. If you see blue, that's more affordable. If you see orange or a little bit red, or see the black line below, which is a 12-month moving average, that means it's a little less affordable. You can see how it has moved. We do see fertilizers being more affordable. We see relatively decent fertilizer prices as we go into 24, a little cautious as we get into the last half of 24, depending a little bit on how the winter goes and whether we see high heating bills or high demand for natural gas. But overall, affordability for fertilizer we do expect to see that be the case for 2024. Just some preliminary numbers when we talk about acreage in the U.S. We do see bean acres coming up quite a bit in 24, back up into around the 88, 89 million acres. Corn acres will come down. We see wheat acres on a slow slide because they're both like corn and wheat. The profitability or the margin of the farmer is not very good. But I think we have to recognize that. And that's when we look at soybeans have a very good return for the farmer. It's still positive. And I think that's where we have to be careful. And that's also the same with oilseeds. Overall, the return on oilseeds continues to be better than if we look at grains. And part of the reason for that is what's happening within the biofuel sector. This is all about renewable diesel. And so renewable diesel is the green line there. And you can see that it continues to grow. You see that biodiesel, the blue line, is basically flat to down. And you can see ethanol, while it came up, but keep in mind, it's the scale. It really hasn't changed all that much. It's been relatively flat over a pretty long period of time. But I want to show you the demand for renewable diesel. We just updated these charts here recently, and you can see as we have shown this chart before, we continue to see a rise again in 24 of capacity for renewable diesel, which will continue to increase the demand for oilseed feedstocks or fats and oils in the U.S. and in Canada going forward. I do want to show this chart here just to show a little bit on the feedstock side, and I think this is worth talking about, is that when we look at the feedstocks, you can see the huge demand for fats and oils in the United States for bio-based diesel, biomass diesel, primary renewable diesel. So also look at canola. Canola continues to grow. And for those of you who are farming in the northern part of the states, and those are obviously in southern Canada, while we have had going to have a huge increase in soybean crush capacity in the United States, we're also seeing a significant increase of 2 to 3 million metric tons, maybe 3.5 million metric tons of canola crushing capacity in Canada. So those crops are going to be demanded. And for those of you who sit in the northern parts of the United States and of course Canada, that will be a big boom there. And I think you need to take advantage of and really think about that. And for potato growers, it potentially gives you another rotational crop that you may not have thought about before, and think about where your market is, particularly those as you get farther north, able to get into Manitoba and Saskatchewan, where the new canola crushing plants were being produced. I'm going to stop there because I'm getting a little long on my time, but I do want to just spend a moment, and I'll start with this slide a little bit just to talk about the markets and talk about where we are. So when we think about where we are in the markets and where my head is, I would tell you primarily we're sort of in the doldrums here. The market is kind of decided that, you know, we want to be bearish. Everyone's bearish. And so, the buyer has said, I've been rewarded for staying pat and waiting for the market to come to me. And so we'll just wait for it to get there. And so the buyer looks at that and goes, I don't need to be in a hurry. And the market looks at that and goes, oh, soft demand. In the aggregate, the demand will be fine, as we showed earlier, but it's just that the immediate demand looks soft because the buyers is buying more hand to mouth than when prices are going up. They're buying as much as they can because they're trying to get ahead of the price increase. So keep that in mind, and don't get lulled into a sense of complacency. Oh, demand's terrible. Demand's not terrible. It's just the dynamics of the demand are just a little bit different. But when I look across the markets and think about which markets have the most upside, I look at wheat having the most upside here just because of what you see on the stock situation going forward. The and then on the opposite end of that spectrum, I look at corn. Corn has the least amount of upside potential because you've had this huge buildup in stocks. And when you look at soybeans could go either way. Again, on the edge. Depends on how big is the crop in Brazil and how big that crop or how many acres we get planted in the U.S. The soybean crop could go either way. But when you look at soybeans, they're much more like wheat in that they have very low stocks level. And so you've got to get some stocks built up. And so I would say, as a seller here, do not get complacent. I think you have to reward rallies here. And if you're a buyer on the livestock side, you have to reward dips because we're in a market, as I said, the doldrums, where we're very willing to trade a range. There'll be a lot of volatility within that range because for all the things I've talked about. And when those upsides get there, you need to be a wise seller. And if at the same time, the buy side, you need to be a wise buyer when we see those dips. So with that, I'm going to stop, and I'm going to at least bring to the very end of this, our lawyers always tell me, you don't, everything I said, I'm an idiot, so be careful about that. And there's my contact information as well. And reach out to me if you want to. And as I said, there's the disclosure from the lawyers that say, don't listen to me because I'm an idiot. But with that, I will stop. And I look forward to those of you who are not able to come to the Business Summit, the Potato Business Summit this year, or Potato Expo. I'm sorry I'll miss you, but I look forward to seeing you next year. And I hope this was helpful. But please reach out to me if you have questions. Thank you very much.